than I did before, but I can get even better rates still in the US. Now that gap, sure, it'll close a little bit, but what's the compelling case to invest in Europe right now, even with rate hikes? And these rate hikes might turn out to be counterproductive. So I think that's a little bit of the message we're getting right now, but that's, I think, not the whole story in Europe. But
okay, so I've heard the statement, it's not the rate hike, it's where they're going and the terminal rate that they're shooting for that's more important than what they do at each individual meeting. So this was a hawkish hike with the guidance that you're telling me, somewhat hawkish for her to say we have a lot more wood to chop and head towards 3%. I'd call that hawkish, wouldn't you?
Yeah, it absolutely was. I think there's an effort here to push up the expected terminal rate of where Europe is going. Well, clearly to me, that's the case here, but the market doesn't love it. And, part of that is Powell's talking at the same time here.
Yeah.
It's all happening at once. And there's a lot of other things happening in European energy as well that the market's also trying to navigate. So, this isn't happening in a vacuum right now. It's a wild news day.
Okay, so isn't it a possibility with the limited tools they have for this energy crisis that say a 10%, 20%, which most people think is inconceivable at this point? I don't. A rally, a stronger euro would actually help them at least, perceptively have take a little edge off the severe inflation of the energy crisis, having a stronger euro.
Yeah, it was interesting. Lagarde was asked about that directly, and did the usual, we don't talk about the currency, but she went a bit further this time and said, in terms of trade, what and whatnot, she's alluded to that it's really just a US dollar rally. So if you look at the euro against sterling, yen, a lot of emerging market currencies and other trading partners, it hasn't depreciated that much. So she sort of waved that off.
Not lately. That's true,
though.
Adam.
I think it's just less so. So it's interesting that she mentioned that to say, you know what, we're not going to try to do it through the euro. Not that I don't really think they have a lot of leverage to do that anyway. A lot of levers they can pull on that. So, if you look at like euro yen or something like that, it's doing better than the euro yen, which is another story altogether. But there's just so many moving parts right now. But I mean, to go on a bit of a tangent, what I'm thinking about right now in Europe is energy policy. I think it's a lot more important than what's happening at the ECB today. If we remember the COVID bottom, start of March 2020, that everything was going to shut down, businesses were going to lose a ton of money, millions of people were going to die. Middle of the month was when the bottom came, and it was when government said, we'll take all the losses. Corporates aren't going to take any losses. Consumers aren't going to take any losses. We're going to take it all. And, that was the buying opportunity of a lifetime. And central banks were playing along as well. This time in Europe, we're seeing that now. So the European economy minister earlier in the week or last week was saying there are going to be businesses closing. Tough luck. Price energy's got to be paid for. This week, he said we're going to cast a wide umbrella.
Yeah.
And in the UK, Truss came out and said, you know what, we're going to spend 100 billion, 130 billion pounds just for consumers to cap energy prices at 2,500 pounds a year, which is not substantially higher than it is now, certainly not at a crippling level. Now, they'll probably do the same for businesses there as well. That's hinted. So we're at the point here where governments are saying, you know what, we're going to take all the losses. And, if you're buying businesses, it's great news. If you're a bank lending to business, it's great news. So European equities here to me look very interesting on that shift in tone. Now it's sort of country by country specific issues there. And there's going to be a big EU finance ministers meeting on Friday that I think will try to hammer out some coordination and some rationing. Otherwise, we might see this sort of beggar by thy neighbor disaster go on because there isn't enough energy to go around. They do need to conserve somehow. But that to me is a very interesting telltale sign that we could be at a bottom, particularly in stocks, maybe also in the euro and the pound. But What's different this time is that central banks aren't playing along. You know, in COVID, central banks financed it all, went to zero, said we're going to stay at zero. They sent the most powerful signals they've ever sent. This time it's the opposite, right? They're hiking rates. And on top, you already have a mountain from COVID. The UK, by their numbers, will spend as much on this as they did on COVID. And that's just for 2 winters. This could take 3 or 4 to solve. So, you know, do you want to be investing in a region that has that sort of uncertainty ahead of it? That's a little bit tougher question to answer, but I think.
Well, I mean, isn't that the way we felt on the COVID crash? Isn't that the way we felt? The market felt in June before we had a face-ripping rally in S&Ps. You can't find. I mean, I've looked at DSIs, Adam. You know the DSI, and they've been low double digits. We were at 11% bulls on the euro, 9 on the S&P. We have more bearishness now than we did in June, and the market hasn't given up all of its gains. So I'm wondering if if we do get a weaker dollar, since all the multinationals are complaining about it and it's affecting their earnings, that a dollar break would be very welcomed in equities, I believe, all over the world, not just here in the US, but all over the world, emerging markets, Europe. So I'm thinking that there's a possibility we're having a bottom in the euro. Now, you know, I don't think people.
I think I just made the case that I mean, and what's been priced in, right? If you look at the last couple of months, say in sterling, which I think is a little clearer to me, because you have sort of one policy making, and now we have a clear kind of policy. You know, you got, what do we have? That's a little short term there, but if we go back, I mean, we were at 135 at the start of the year. Is that right? Yeah, 138
right in here.
Last year, whatever. So, you know, a lot's been priced in terms of an energy crisis. You know, maybe in terms of bankruptcies, in terms of a dead consumer. And now we're hearing, listen, the consumer's going to be fine. Now the government, the debt, the long-term yields are blowing up. Again, though, that's still, you know, government debt crisis is a tough one to trade. It happens when it happens, and I don't think we're at that point in the UK. So maybe that's a long-term headwind to growth, but right now we're saying, you know what, there's been a huge government policy move here to get on top of this. Also, we're seeing a few cracks in TTF prices, although they're positive now on the day after a big drop. So, you know, there might be a way out of this. And I think the UK looks a little bit more interesting than the Eurozone right now, but you know, it's the same idea in both.
Okay. Because, you know, I was talking a little bit yesterday about, I said, the pound is not a short at 114, exclamation point.
To 120, I mean, it's a nice trade, right?
Yeah. So, you know, I mean, even though EG has blown up on this move, I mean, hell of a move in euro pound, I wouldn't be chasing it now. So it's interesting that you know, would be more positive in on the UK weathering the storm. And, you know, I'm starting to get some technical indicators that, you know, maybe the pound has bottomed at least temporarily and the dollar has peaked temporarily. What do you think? Got a recovery in cable? Yeah,
well, you know what? We've talked about this before. Sentiment is the most powerful indicator in markets, but you know, there's never any way of really knowing where it is. Some sort of indicators, but like you said, it couldn't get much worse for the UK and Eurozone right now.
Yeah.
And again, the dollar business is strong as well. Yeah, Powell, he keeps coming out. He did it again today. He talked a real tough game. I think the real Fed was Brainerd yesterday, who came in a much more nuanced view, saying, listen, fuel prices are falling, used cars come down, you know, margin compression because demand's not so high. You know, Europe, China slowing, that should take some pressure off aggregate global demand. You know, a lot of reasons that inflation might not be so high and they might not have to hike as much. There's a risk of over tightening.
All right. Well, you know
So
what, Adam, you're one of the first to bring up your concerns about China. And that was well over a year and a half ago, before we had continuous zero COVID and massive lockdowns. And
and
I'm
they're going down.
wondering, since you called that, is there a possibility after Xi gets through whatever he gets through in October to become, president for life, that they try something else and reopen and drop
And
the zero COVID policy?
it seems to be now all over the country, right? More and more lockdowns. There's no way out of this. I think they have to, and they have to look at the rest of the world and say, you know what, it wasn't so bad. And a lot of narratives are hanging on this October. I think it starts October 16th.
Yeah.
Told People's Congress, probably the most important event for the remainder of the year. You really, really hope that's the case. And I would imagine a lot of that's even in, because everyone just looks at it and says, can't go on. When I worry,
that would be a tailwind, wouldn't it, for the world? I mean, they're
huge.
easing, and if they reopen, demand goes back up for energy, commodities in general.
A big one on that trade, I think. Energy, all commodity, copper, a lot of that would probably be the turning point. I'm a little bit sidelined on some of the trades right now, but I'm a big long-term bull on it. That is what we need. We need China to get going. Europe, what they're doing now, taking all the losses. You remember, okay, if they cap energy, listen, you've got incentive to turn the heat down. So that's more energy demand. It's a bit of a mistake in a lot of ways, because it might end up costing the government a lot more.
So they're risking a sovereign debt crisis down the road to have their population survive and still be able to be consumers.
I think probably the right call, but definitely taking from the long-term growth and bringing to the short. And you didn't want consumer bankruptcies, business bankruptcies. I mean, that's tough to come back from. So you take it on, but you should try to finesse it where you try to bring down demand too, rather than just saying the most you're going to pay is 2,500 pounds. So you might as well warm this winter and not conserve. That could end up costing the government a lot more and making that debt crisis down the road a lot worse.
Look at that wick in euro right there.
It's a lively one. And, like I said, there is that case right now. The energy story is the real story. We're in rates. Everybody's watching central banks now, but there could be some real good news for Europe as a whole there. Again, the debt crisis, sure, whatever. But, governments can borrow a lot before we hit the absolute limit, which kind of brings us to the end, which is...
Can you, explain this to me? Let's
what a
go
chart.
back.
What a chart.
There you go. There's
we talked a couple months ago, Dale, and I was talking about 145 dollar yen. And I think that was the line you put up on our talk. And, we have 1,498 yesterday. So
clean it up. No, I think we got a 45 print, man.
I mean, it was just one of those
99, Adam. If you can't be more accurate than that, I don't know about continuing the interview. You missed it by a whole pip.
It was obviously one of those moves that has to kind of end in a blow off, and I still don't think
doesn't it have any, I don't know, implications for Japan? Most countries that would have their currency do something like this, be down 40% in a year, would you'd see people trying to on the streets trying to exchange your yen, Japanese peso, for almost anything.
It's shocking, and it's shocking that reported inflation it doesn't make any sense. They import everything in Japan, and somehow I don't understand how
does
there's
it
some
end?
tougher talk right now. I don't think it did any effectively. It came out overnight, and the toughest talk about blah 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 jawboning, and the market just doesn't care. I mean, it's up and 10 pips today. Down a little bit yesterday, but that was sort of a dollar correction more broadly. It wasn't yen specific.
Yeah.
And so I just, either the bank risk is the Bank of Japan off the rug, says, we're in a yield curve control, and
Oh,
that's,
really?
or we see other real disorderly moves, but I think there's a less risk of that now, given what Europe's doing. Although, the Fed's a big risk as well. If we start to price in 5% rates, I would say, on the equity side, what would you rather have? And I think the market's thinking, what would you rather have, a quick move to 4% rate, stay there, or we kind of powder along and down the road, there's a rise or growing risk that we have to go to 5%. I think the market doesn't care if they get to 4% this year, as long as we're not worried about 5-6% rates. So that, I think that's the line in the sand where markets are saying, all right, fine, Powell, if you want to put the pedal to the floor or slam on the brakes and get to 4%, 3.75%, 4%, you know what? That should probably head off inflation. Maybe it's a little bit too much, but it's not 5 or 6%. And I think corporates can do fine. I think the economy can do okay. Yeah. Housing, maybe not so great for a little bit, but most people are on a 30-year fixed anyway. You heard a few. Everyone else doesn't even notice. Corporate borrowing, I mean, yeah, you've got some, you slow it down a little bit there, but everybody got a lot of free money during COVID. So balance sheets are pretty good.
Pretty
And
interesting spot S&P's held yesterday.
well, I like it too. You didn't, I mean, a lot of people were like, let's go retest it. Let's go retest it. You don't want to get all the way down to that retest in the bottom. You want to kind of get, okay, here. I mean, maybe a little less would have looked a bit better. Is that
and
the 200-day on there?
bearish. Sentiment is bearish here than as it was back in June when we were at 3,600.
Yeah, well, that's it again. People, and it was a pretty powerful move yesterday. Yeah, everyone says short squeeze, short squeeze, short squeeze. It always starts with a short squeeze. I mean, that's the only thing it can be at a bottom. So again, yeah, I think there is, and they know, look at oil prices are way down. Inflation, I mean, what are they going to say? Maybe at the midterms, they have year-over-year negative gasoline price year over year by November. And I mean, the US is going all out on that. I still think this Iran deal happens. So, there's a pretty good chance. And I think the central bankers are probably in Europe. There's a chance a year from now or next summer anyway, they have like 1% inflation and negative growth. And then they look like jerks again, right? So they get, they blow this one, inflation pops, and now they get all gung-ho, we're going to keep rates up high for longer, crush inflation.
And they kill the economy.
And then they kill the economy on the way down. And you think, like, what are you guys doing? Because right now there's this mantra, right? We got to get rates up and keep them there so we don't repeat the 70s. It's like, come on, there's no creative thinking, right? Just look at the history textbook, do it, whatever worked there, whatever the narrative was that worked there.
Why don't we, is it possible the last, say, 10 minutes, we talk about the seasonals? Because I think there were a few key developments in the market this week. We kind of covered FX, but I'm impressed with silver. We came out of a falling wedge. The gold silver ratio seemed to have peaked at the 50% level. And if I get a negative close on the gold silver ratio, we could be in for a nice decline, which supports the outperformance of silver over gold, which you see today with it up 12 and gold down a couple bucks. So you have anything in the metals for your seasonals in September?
There's not a lot going on in metals. They're sort of softish until the turn of the year. And it's that people have started front run that more and more. So I think it's late November where you want to play that turn of the year move now, because I think we're seeing more and more of it bleed into December. So there's a good buying opportunity in November for precious metals. That's when the seasonals say to buy, and that's been a really good trade over the last 10 years, I think.
Okay.
And on the debt thing, I mean, I think there's a pretty screaming buy here from Europe to say, listen, we're going to push more debt. They're already. The UK doing this. The US certainly had another. Democrats managed to hold on another 2 years with majorities in both houses, then how much more spending is that as well? And that is a possibility.
Okay.
So there's a lot to like with precious metals at the moment.
Do you look at the futures at all in the metals?
Curve?
Or yeah, we're in backwardation in silver, aren't we?
There are, like, the inventory numbers are very interesting in a lot of metals. They're not, I'm always skeptical of the inventory thing because we've been hearing about it for so long, but it's compelling that it's tough to source the physical right now. And that would be, you see gradation in something like that.
And that's usually bullish.
Definitely.
Carrying charge markets are normally bearish. So, okay,
I mean,
so I think we've covered a lot. You talk about copper, and are you impressed that we had this S&P sell off, and copper after its June rally really hasn't given up as much, almost has a better structure than the S&Ps. They kind of look
it is
similar, don't
impressive.
they?
It's similar too, right? And it's,
Yeah,
again, I think it's that Europe story. Okay, Europe might be okay. And China, they are cutting a bit. There is some stimulus talk out there. It doesn't look great for China right now, but a lot is hanging on that sort of October narrative. And I think you can wait. I mean, yeah, if things get cheap, or you like a miner that's beaten up as the stock market is, that's maybe a good time to pull the trigger. But I kind of, on a lot of these metals, global growth trades, I think I can wait till end of October, November, even turn of the year, and say, I missed sort of the bottom, but let's see how things look then. Because if we do start to get a real sense, okay, inflation is bottom. Central banks, they're talking tough about keeping rates high for a long time now, but if the economy falters a little bit, we can get a reversal and all that. We can get China stimulating. Who knows what's going to happen in Russia and Ukraine.
yeah.
But their balance sheets, again, are pretty good for consumers and businesses. So there can be still some investment spending here. Employment is still very strong, right? And I think it's hard to say what's really priced in or what the market's worried about. But if you can take away that risk of 5% rates, you put in something like a modest recession, but towards the end of next year, rates coming back down from central banks. Listen, I think the turn of the year is about the time to buy that.
Okay, so we could have that setting up. Geopolitically, do you think that NATO's going to break and go with Putin, and cut some type of deals? That would be his objective. He may be having problems on the ground, but a victory for him would be a NATO country breaking away from the alliance for energy, cutting a deal.
In my view, Putin is winning this war beyond his wildest dreams. I mean, he's taking down all of Europe. The debt that they're spending is going to be multiple times, like the size of the whole Russian economy, the debt this is going to cost Europe. So what's the rush? He's still got the gas. They still need the gas. Yeah, fine. The LNG will come on, but time seems to be on his side. He doesn't need to conquer Ukraine. And I'm sure the Ukraine economy is in tatters. So yeah, you just leave that pain out there, and you hear sort of Italy, you're going to hear companies. I worry that we get in this echo chamber sort of in the Western media, right? Where if somebody, a parliamentarian somewhere, or somebody powerful like in Italy right now, is saying, you know what, enough is enough, we don't really hear it. It doesn't get amplified in the same way as the, let's send another 1,000 tanks there or whatever message does. So, those cracks are hard to find, but you do see them. And, the crumble starts with a crack. And there's a lot of pain there. And you say, wow, you just wonder how it's going to go. Then again, we might not be seeing cracks in Russia either. So that's the fog of war. It's very tough to see how it goes, but Europe is suffering a lot right now with these high costs.
Yeah, I can't imagine any kind of dissolution of NATO or even defections would be fundamentally bullish for the dollar.
Yeah, I mean, in Eastern Europe's got to be just in tatter, right? Like some of these
The
countries get
Baltic
way more
states.
gas, yeah, than Europe. They seem to be the most anti-Russian at the same
Right.
point.
Well,
But
you know why? They have a memory.
well, that's that, right? So I mean,
Yeah.
it's tough for them to lay down because they do feel that existential threat. But
They
yeah,
lived it.
ultimately
Their
the
ancestors.
economics of it are tough. But I just don't see why Russia would be rushing anything right now,
Okay.
in terms of the war.
That's good. Why the
Yeah, yeah.
Russians would rush.
Poor pun.
I just wanted to, as you can tell, Adam, I like silver. Okay. So silver made a new low, and look at this stock. It's fairly well known, First Majestic. It didn't make a new
Yeah.
low with silver. And I'm just wondering what it means. I mean, it could mean, that,
Well, take it. It's the same in a few commodities. I think that, like, if you look at XLE, for instance, oil, which is
yeah, I have it.
it's the same along the same lines. But you got it there already. Yesterday oil down 5%, XLE
It
not
looks great
that
still.
much. Exactly. So you have oil now at the worst of the year. And how
Yeah.
much is that? A good 10% of more, maybe 15%, maybe even above the July low. So you see some multiple expansion in a lot of these commodity trades. And I
It's a
think the
great
place to
point.
be is in the equities. People are saying, listen, we were pricing some of this stuff at 4 times earnings, and they got a reserve life of 30 years. And
Yeah.
looking at all the spending and saying, you know what, I want to commodities. A lot of, I think, we're looking for these opportunities to get into commodities. A lot of managers, fund managers, because they can see the writing on the wall and undersupply in a lot of these markets.
Right.
Russia
Well,
talking about putting more of its reserves in gold and silver. So there's something to like here in terms of oil is a good 10 lower than it was in
yeah, that's a
July.
very interesting chart compared to oil. Any comment on the recent bearish action in Bitcoin? Does it have a chance to hold here, or are we going to flush to
Better.
another 4 or 5 grand?
Surge in Ethereum. I think that's where I'm watching right now. Maybe the 15th is the day for that.
Yeah.
So a week away. And
If
I
it
think there's a lot of
rallies, are
bullish.
you going to sell into the merge and not yield right away?
I mean, if we
Take it out.
we've seen a sort of driven narratives around Bitcoin a lot of times, right?
Yeah.
The halvening,
Yeah.
regulation, futures, ETFs,
Yeah.
and there's always a run up at it, and then kind of disappointment after it. And looking at this run up, actually pretty big in percentage terms, but on the chart it doesn't look like much still. In the
Maybe
last,
2,400 or something.
I mean, it went from like 900 to 2,000, which is a solid double, but
Yeah.
there's not a lot to love in that longer term. And I don't know, Buzz just seems to have moved on. I don't know. That's sort of my read on it. Is there's a lot of exhaustion in kind of the true believers
Yeah.
in to see that real change in the world, right?
Yeah.
I think a lot of people were preaching.
Yeah.
I am a bit bearish here.
Okay. All right. Well, I'm bullish on you and what you do for the trading public, Adam, at
Thanks
Forex
so much.
Live.
Likewise,
And
we've had some
and
good
and
talks in the last little
yeah,
while.
and I'm also very constructive on having conversations with you because I learn. It's interesting to me. I was thinking Europe and your preference of the UK over the continent is interesting to me, where I'm going to be delving into, ways to take advantage of that narrative. So I always appreciate our conversations, and they really add value to people that might be confused about like you said, there's so much happening that it's almost like you get desensitized and it's hard to keep up,
Yeah,
especially
or
when you
tunnel
have
vision.
this. Yeah, yeah.
The
You have
Euro,
as
the
much.
ECB today, it's the main event,
Yeah,
and I think that the energy story is really where the trade is. So
right. And then you have Powell talking after an ECB meeting, and I mean, we're really getting pounded. You can't say it was a dull August and September's off to, a real newsy month. So I recommend people follow you and check you out, and go to Forex Live, and include you in all of their intelligence gathering.
Thanks so much, Dale, for that. And thanks for having me again. And I look forward to talking with you again.
All right. My trading warrior brother, Adam Button, everybody. Check him out at Forex Live. Thanks, Adam. I'm a fan, always rooting for you. Go get them. This is your kind of market.
All right. It really is. Right back at you, Dale. Cheers.